Welcome back to Capital Investment Decisions. This is part 2. As a disclaimer, the information provided in this video is for educational purposes only and should not be considered as financial or investment advice. Always consult with a CPA or your financial advisor before making any financial decisions. The content is based on current information and may not reflect future changes or developments. We're beginning this series on Learning Objective 3, use the time value of money to compute the future and present values of lump sums and annuities. $1 received today is worth more than $1 to be received in the future because you can invest today's dollar and earn additional income so you'll have more cash next year. The fact that invested cash earns income over time is called the time value of money. Now, this concept explains why we would prefer to receive cash sooner rather than later. The time value of money means that the timing of capital investments, net cash inflows, is important. Two methods of capital investment analysis incorporate the time value of money, which are net present value and internal rate of return. The time value of money depends on several key factors. 1, principal amount. 2, the number of periods. And 3, the interest rate. Now, the principal, which is represented by the letter P, it refers to the amount of the investment or borrowing. Now, because this series deals with capital investments, we primarily discuss the principal in terms of investments. However, the same concepts apply to borrowing, such as mortgage payable and bonds payable, which we cover in financial accounting. We state that the principal as either a single lump sum or an annuity. For an example, let's say if you won the lottery, okay? You have the choice of receiving all the winnings now, which is a lump sum, or you can receive the money during a series of equal payments for a period of time in the future, which we call annuity. So annuities, payments received during in the future. So an annuity, again, is a stream of equal cash payments made at the equal time intervals. Like I said earlier, for example, if you won the lottery and you decide not to get the lump sum, but say you decide to get, you or receive, say $100,000, $200,000 a year for the next X number of years. So that's what the annuity is. An ordinary annuity is an annuity in which the installments occurs at the end of each period. Simple interest versus compound interest. What are they and what are the differences? Now, simple interest is calculated only on the principal amount. Compound interest is calculated on the principal and all previously earned interest. Compound interest assumes that all interest earned will remain invested and earn additional interest at the same interest rate. Here in this exhibit, you see, you have to your left the simple interest calculation, and to your right, you have compound interest. So you have the simple interest to your left, and then you have compound interest to your right. Okay, so as you can see, the amount of compound interest earned yearly grows as the base on which it is calculated, meaning the principal plus the cumulative interest to date grows. So over the life of this investment, the total amount of compound interest, of course, is more than the total amount of simple interest. Now, most investments yield compound interest, so we assume compound interest rather than simple interest for the rest of this video. Fortunately, time value calculations involving compound interest do not have to be as tedious as shown in previous exhibits. Now, business calculators and Excel spreadsheets are used, to calculate interest, okay? In addition, there are also tables, and those tables are actually at the end of your textbook. Now, these tables have the present value factors, which can be used to simplify the calculations. The future value and the present value factors. The future value or the present value of an investment simply refers to the value of an investment at different points in time. Now, we can calculate the future value or the present value of any investment by knowing or assuming information about the three factors that we talked about earlier, which are your principal amount, the number of periods, and of course, the interest rate. Here on the screen, you'll see that the future value formula is future value equal present value plus interest earned. In the case, the future value of $10,000 investment, you're investing it at the 6% for 5 years. Here you see on the screen, the future value of $10,000, which is the principal for 5 years at 6% is equal to what? The future value equal to the principal plus the interest earned. And that is $10,000, which is the principal, and the 6% interest on the $10,000 is $3,383, which will give you $13,383. At the bottom here, you see where you can actually rearrange the equation to get your present value. So the present value is equal to the future value minus interest earned. And of course, the present value, which is the principal amount, the $10,000, is equal to the $13,383, which is your future value minus the interest, $3,383. Now, calculating each period's compound interest that we did earlier and then adding it to the present value to determine the future value is a tedious process. Fortunately, we do have calculators, we have Microsoft Excel, and then we have those tables in the back of your textbook. But again, mathematical formulas have been developed that specify future values and present values for unlimited combination of interest rates and time periods. Separate formulas exist for single lump sum investments and annuities. Now, these formulas are programmed into most business calculators, so the user only needs to correctly enter the principal amount, the interest rate, and the number of time periods to find the present or the future value. Now, these formulas are also programmed, again, like I stated, in Excel. My personal preference is using Excel. So in this section of this video, we will use the present value tables. The Excel formulas are illustrated later in the videos. Okay, note that because the table values are rounded, the Excel results will differ slightly. Now, the present value tables contain the results of the formulas for various interest rate and time period combination. Now, the formulas and resulting tables, like we talked about, are found at the end of the book in Appendix A. So here you see the table in front of you. The present value of $1 is in the textbook Appendix A, Table A1. And what is used to calculate the value today of one future amount. And this table, you can take a look at it later. So the present value of a lump sum. So how much would you need to invest today in the present time to have $13,383 in 5 years if the interest rate is 6%? So again, we would use the table, use the PV, present value factor, from the present value of the $1 table that's located in the end of your book. So the present value is equal to future value times present value factor for I equals 6%, N equal 5. Present value is equal to future value times present value factor for I, which is 6%, number of years, N equal 5. You have the future value of $13,383 times 0.747 equal $9,997. Again, this information is taken from the table, the present value factor table that's at the end of your textbook. Present value of an annuity. Now, let's assume that instead of receiving a lump sum at the end of 5 years, you'll receive $2,000 at the end of each year. Now, this is a series of payments of $2,000 over equal intervals, years, so it is an annuity. So how much would you have to invest today to receive these payments, assuming an interest rate of 6%? So here you have the present value equal amount of each cash flow times annuity present value factor for I equals 6%, and representing the number of years equal 5. So you have the $2,000 times the 4.212 equal $8,424. Again, this 4.212 is the information that you will receive, or you should see, in the table at the end of your textbook. Okay, so let's verify the calculation. Here you see the chart that shows the initial investment of $8,424 that is invested for 1 year, and it earns $505 in interest. At the end of that period, the first withdrawal of $2,000 takes place. The first $2,000, okay? Leaving a balance of $6,929. Okay? That's calculated as $8,424 plus $505 less the $2,000. So at the end of 5 years, the ending balance should be 0. Of course, you don't see it here, but it will be 0. Because here at year 5, you see that the ending balance is $1,886. Okay? But the beginning balance is the $1,886 plus the $114 interest, which will still give you that withdrawal of $2,000. Present value examples. So let's assume that you have just won the lottery after you purchase a $5 lottery ticket. Then the state offers you 3 payout options for your after-tax prize money. So you won the lottery for $1 million, and you paid $5 for the lottery ticket. So you have 3 options. 1, lump sum of $1 million Option 2, you prefer $150,000 at the end of each year for the next 10 years. Option 3, you want the $2,000 at the end of 10 years. Okay, so which one would you take? You might be tempted to wait 10 years to double your winnings. You may be tempted to take the cash now and spend it. However, assume that you plan to prudently invest all the money you receive, no matter when you receive it, so that you have financial flexibility in the future. So how can you choose among the 3 payment alternatives when the total amount of each option varies? Comparing these 3 options is like comparing apples to oranges. We just cannot do it unless we find some common basis for comparison. So our common basis for comparison will be the prize money worth at a certain point in time, namely today. So in other words, if we convert each payment option to its present value, we can compare apples to apples. Here in this example, it shows each payout option converted to common basis is worth today, right? So we can make a valid comparison among the options. So based on this comparison, you might want to choose option 2 because it is worth, in today's dollar, the highest amount of the 3 options. Option 1 is 1 million, option 2 is 1,065,000, and option 3 is 926,000. Okay, so the lottery problem is a good example of how businesses use discounted cash flows to analyze capital investments. Now, companies make initial investments to purchase the assets. The initial investment is already in present value, similarly to the lottery option number 1. The purpose of the investments is to increase cash flows in the future, but those future cash flows have to be discounted back to their present value in order to compare them to the initial investment already in present value, similar to lottery option number 2. Now, some investments also have a residual value, meaning the company can sell the assets at the end of their useful lives and receive a lump sum cash inflow in the future, similar to option number 3. Now that you have reviewed time value of money concepts, in the next section, we're going to discuss the 2 capital investment analysis methods that incorporate the time value of money, meaning the net present value and the internal rate of return. Future value of a lump sum. So we determined that the future value factor from the table labeled future value of $1, right? Again, that's at the end of the textbook. Now we use this table for lump sum amounts. So if you were to look at the table, you look down the 6% column and across the 5 periods row, and then you'll find that future value that should be 1.338. So the future value is equal to the present value times the future value factor for I equals 6% and equal 5. So that would give you the $13,380. Assume that you will receive $2,000 at the end of each year. How much would these payments be worth 5 years from now, assuming an interest rate of 6%? Again, we're getting the information from the table in the appendix. Future value is equal to the amount of each cash inflows times annuity future value factor for I equal 6% and equal 5. So if you receive $2,000 at the end of each year, how much will these payments be worth in 5 years from now at an interest rate of 6%? So it will be $11,274. And you get that by multiplying 2,000 times 5.637. And here we are at learning objective 9.4. Use discounted cash flow methods to make capital investment decisions. Neither payback nor accounting rate of return recognizes the time value of money. That is, these methods fail to consider the timing of the net cash inflows an asset generates. Discounted cash flow methods, the net present value and the internal rate of return methods, overcome this weakness. Now, these methods incorporate compound interest by assuming that companies will reinvest future cash flows when they are received. The net present value in the IRR methods, oops, sorry about that. Okay, sorry about that. The NPV and the IRR methods rely on present value calculations to compute an investment's initial cost with its expected net cash inflows. Recall that an investment's net cash inflows include all future cash flows related to the investment, such as future increased sales or cost savings, netted against the investment's cash operating costs. Now, because the cash outflow for the investment occur, but the net cash inflows from the investment occur in the future, companies can make valid apples to apples comparison only if they convert the cash flows to the same point in time, namely the present value. Net present value. Now, if the present value of an investment's net cash inflows exceeds the initial cost of the investment, that's a good investment. So in terms of our earlier lottery example, the lottery ticket turned out to be a good investment because the present value of its net cash inflows, meaning the present value of the lottery payout under any of the 3 payout options, exceeded the cost of the investment. And remember, the lottery ticket was only purchased for $5. Okay? So net present value is a capital investment analysis method that measures the net difference between the present value of the investment's net cash inflows and the investment's cost. The discount rate is management's minimum desired rate of return on a capital investment. Okay, we're going to use we're going to use Smart Touch learning. So we'll bring that back into view. Smart Touch learning is considering expanding their production. They want to include laptops and desktop computers, with each of the project considered a separate potential capital investment project. So each one will be a separate project. The projects each require the purchase of one specialized machine. Now, each one of these machines costs $1 million and has a 5-year life and has 0 residual value. The 2 projects have different patterns of predicted net cash inflows, as you see here. The laptop project generates more net cash inflows, but the desktop project brings in cash sooner. To decide how attractive each investment is, we find its net present value. So, Smart Touch Learning expects the laptop project to generate $305,450 of net cash inflows each year for 5 years. $305,450. Okay, let's get that straight. So the NPV is $48,610. So how do we get that? Let's see. Present value is equal to the amount of each cash inflows times annuity present value factor for I equal 14%. N equal 5. So that's $305,450 times 3.433 will give you $1,048,610. So when you have the present value now is $1,048,610, the initial investment, remember, was $1 million. So the net present value of the laptop project is that $48,610. That's how we get that number. So here we are at the decision room, net present value. If the NPV is 0 or positive, the company should invest. If the NPV is negative, do not invest. NPV of a project with unequal periodic net cash inflows. In contrast to the laptop project, for the desktop project, the net cash inflows are equal $500,000 in year one, unequal, $500,000 year one, year two is $350,000, year three, $300,000, year four, $250,000, and year five, $40,000. Okay? Because these amounts vary year by year, Smart Touch Learning managers cannot use the annuity table to compute the present value of the desktop project. So what do they have to do? They have to compute the present value of each individual year's net cash inflows separately as separate lump sum received in different years. Okay, so in other words, they have to go year by year to compute the present value. The net cash inflow received in year one is discounted using the present value factor of 14%. And if from year to year, starting from year one to year five, you see that the computation is different because you're basing it on the net cash inflow. Now, many assets yield cash inflows at the end of their useful lives because they have residual value. Companies discount an investment's residual value to its present value when determining the total present value of the project's net cash inflows. The residual value is discounted as a single lump sum because it will be received only once when the asset is sold. So in short, it is just another type of cash inflow of the project. Suppose Smart Touch Learning expects that the laptop project equipment will be worth $100,000 at the end of 5-year life. So to determine the laptop project's net present value, what we will do is discount the residual value of $100,000 using the present value of $1 table at the end of your book, okay? For an interest rate of 14% for 5 years. Then you would add that present value of $51,900 to the present value of the laptop project, other net cash inflows that we calculated previously at, remember, the $1,048,610. Okay, so now the net in cash inflow, $100,000. The PV factor is 0.519, which will give you the $51,900. Okay, and now you would add these two, the present value of the annuity plus the present value of the residual value will give you the $1,100,510. And now you have to subtract the initial investment of the $1 million, which will give you the net present value of the laptop project at $100,510. Now, if Smart Touch Learning had to choose between the laptop and the desktop projects, the company would choose the desktop project in the first scenario because it yields a higher NPV, which was the $78,910. And it would choose the laptop project in the second scenario because it yields a higher NPV when the residual value is considered, which is the $100,510. However, comparing the NPV of the two projects is valid only because both projects require the same initial cost, which is the $1 million. So in this example, you see here, choose the project with the highest NPV when comparing projects with similar investments. Use the profitability index when initial investments amounts differ. Now we know that all three projects are attractive because each yields a positive net present value, right? However, when you have to make a decision which project should Smart Touch Learning invest in, which one would you choose? By looking at the screen, you would choose project B because it has the highest NPV, which is $38,000 compared to project A at $25,000 and project C at $32,000. So project B would be the best choice. So to choose around the project, Smart Touch Learning computes the profitability index. And remember, we said that the profitability index computes the number of dollars returned for every dollar invested, with all calculations performed in present value dollars. The profitability index is equal to the present value of net cash inflows divided by the initial investment. So let's compute the profitability index for all three alternatives. The profitability index shows that project C would be the best of all three alternatives. Why? Because it has the highest profitability index of 1.21 as compared to A being only 1.20 and B being 1.19. So let's also compute the profitability index for Smart Touch Learning laptop and desktop projects using that first scenario. So the profitability index confirms our prior conclusion that the desktop project is more profitable than the laptop project. The desktop project returns 1.079 as compared to the laptop of 1.049. So because Smart Touch Learning chose the desktop project over the laptop project is the opportunity cost. And remember, the opportunity cost is the benefit foregone by not choosing an alternative course of action. Internal rate of return. The internal rate of return is the rate of return based on discounted cash flows of a capital investment. It is the interest rate that makes the NPV of the investment equal to 0. So when net present value is calculated, the present value factor is selected using the company's required rate of return. If the net present value is positive, then you know that the actual rate of return is greater than the required rate of return, and it is an acceptable project. However, you do not know the actual rate of return, only that it's greater than the required rate of return. So if the net present value is 0, then you know the actual rate is equal to the required rate. The actual rate of return is called the internal rate of return. In other words, the internal rate of return is the interest rate that makes the initial cost of the investment equal to the present value of the investment's net cash inflows, which means the net present value is 0. The higher the interest rate of return, the more desirable the project. IRR of a project with equal periodic net cash inflows. Smart Touch Learning laptop project would cost $1 million with 5 equal yearly cash inflows of $305,450. To compute the IRR, we first set up the following equation. Okay, we compute the internal rate of return of an investment with equal periodic cash flows, which is annuity, by taking the following steps. First, the internal rate of return is the interest rate that makes the cost of the investment equal to the present value of the investment's net cash inflows. So we set up the equation to set up the initial investment equal to the present value of the net cash inflows. The present value of the net cash inflows can be rewritten as the amount of cash inflows multiplied by the annuity present value factor of an unknown interest rate for the given time period. Now, this allows us to solve for the annuity present value factor. So finally, what we do, we find the interest rate that corresponds to this annuity present value factor. Again, you have to refer to the table, the annuity of a $1 table. Okay? And then you'll see that 3.274 annuity present value factor is in the 16% column. Therefore, the internal rate of return of the laptop project is 16%. Now, Smart Touch Learning expects the project to earn an internal rate of return of 16% over its life. So we can confirm this result by using a 16% discount rate to calculate the project's NPV and prove the amount is zero. So in other words, 16% is the discount rate that makes the investment cost equal to the present value of the investment's net cash inflows. So here we are to the decision rule, internal rate of return. If the IRR meets or exceeds the required rate of return, then the company should invest. If the internal rate of return is less than the required rate of return, the company should not invest. In the laptop project, the exact annuity P factor, the 3.274, remember that? That appears in that table. The present value of an ordinary annuity of $1 table. Okay. Now, many times the exact factor will not appear in that table. For example, if we want to find the IRR of Smart Touch Learning business to business portal from the previous exhibit 9.4, okay. Recall that the business to business portal had a 6-year life with annual net cash inflows of $60,000. The investment cost is $240,000. So as you see on this slide, we get what? 4.000 when solving for the annuity factor. So that's the 240,000 divided by the 60,000, which will give you the 4.00. And also notice that this 4.000 does not appear in the PV table. Because the desktop project has unequal cash inflows, Smart Touch Learning cannot use that present value annuity of $1 table to find the asset's internal rate of return. Rather, the company must use a trial and error procedure to determine the discount rate that would make the project's net value equal to zero. For example, because the company's minimum required rate of return is 14%, Smart Touch Learning might start by calculating whether the desktop project earns at least 14%. Here you see this table. It shows the net present value calculation using discount rates of 16% and 18%. So in the middle column, you see the 16%, and the column to your right, you see the 18%. So if we use a business calculator or we use Excel rather than that trial and error procedure, we find that the internal rate of return is 18.23%. So the desktop project's internal rate of return is higher than Smart Touch Learning 14% required rate of return. So the desktop project is acceptable. Okay, here you see is a table which shows the comparisons of capital investment analysis methods. You have the payback, the accounting rate of return, the net present value, and the internal rate of return. You have the focus on each one of them, its strengths, and its weaknesses. We know that managers must use or should use or sometimes even use more than one of these methods to gain different perspectives on their risk and returns. Okay? So this table you can review at your leisure. Okay, so the examples of capital investment analysis methods illustrated in this video, we actually use the present value tables That's located at the end of your textbook, okay? However, you can use Microsoft Excel, which is my personal preference. You can use Excel to perform the what-if analysis, okay? And here you see both the laptop and the desktop computers, the annual net cash inflows at the end of year 5. The laptop has $1,527,250, whereas the desktop computers has $1,440,000. So capital budgeting decisions affect cash flows far into the future. Smart Touch managers might want to know whether their decision will be affected by any of their major assumptions. Okay? So after reviewing the basic information for net present value analysis, managers perform sensitivity analysis to recalculate and review the results. Now, one method of setting up Excel spreadsheet is to have areas of the spreadsheet designated for inputs and outputs. And here you see in this example is the information that you would actually input into the spreadsheet. Here, in this example, it shows the actual formulas used to calculate the net present value and the internal rate of return. So these are the formulas for the NPV. This is the formula. And this is where they chose information from column B, okay, for the laptop. And this is formula that they chose information from column D. And to do the rate of return, this is the formula for the laptops, formula for the desktops. Okay, we have mentioned capital rationing several times, but revisiting the topic is worthwhile. Now, most companies have limited resources and have to make hard decisions about which projects to pursue and which one to delay or to reject. Now, these decisions are not just based on the quantitative factors of payback, accounting rate of return, net present value, and internal rate of return, okay? They're just not based on those quantitative factors. Now, qualitative factors must also be considered. For example, a company may choose manufacturing equipment with a lower net present value because it is more environmentally friendly, or accept a project that is not profitable but adds value to the community. The company should also consider the opportunity costs of rejecting certain projects and the possibility of lost business if there is a negative public perception of the company's choices. So here you see on the screen is the decision tree for capital rationing. Capital rationing. So with this decision tree, first you determine if the plan meets payback and ARR criteria. If it doesn't meet the criteria, determine if qualitative factors change the decision. If qualitative factors do not change the decision, reject the report. If qualitative factors do change the decision, proceed as if the plan does not meet the payback and ARR criteria by determining if the plan meets NPV and IRR criteria. Now, if the plan does not meet the criteria, determine if the qualitative factors change the decision. If qualitative factors do not change the decision, reject the project. If qualitative factors do change the decision, accept the project and proceed to project ranking. However, if the plan does meet NPV and IRR criteria, determine if the qualitative factors still change the decision. If the factors do not affect the decision, reject the report. Let me back up. If the factors do affect the decision, reject the project. If the factors do not affect the decision, accept the project and proceed to ranking the projects. So once the projects are ranked, ask if there are funds available. If funds are not available, reconsider if funding becomes available. If funds are available, acquire and use. So I want to remind you that this decision tree that you should review before you make any decision, whether to accept or reject a project. This decision tree is just used as an example of making a decision. Okay? It's just an example of making a decision. Okay, so this is the end of part 2, which covered objectives 3 and 4.
Thank you for watching, and please do not forget to click the like and subscribe button. And if you have any questions or comments, please leave them below and I will reply to you.